Your Social Security payment is not late simply because it did not appear on the same calendar date you remember from last month, and it is not safe to assume that your bank will always release the money early. That belief sounds harmless, but it can lead to overdraft charges, returned payments, late fees, missed prescriptions, and days of panic. In August 2026, for example, a person receiving supplemental security income may see no SSI deposit during the entire month of August because the August payment was moved forward to Friday, July 31st, when August 1st fell on a Saturday. At the same time, many retirement, survivor, and disability beneficiaries are scheduled for August 12th, August 19th, or August 26th, depending on the birthday connected to the benefit record. The money is not disappearing. The schedule is doing exactly what the rules say, but most people were never taught how to read those rules. Stay with me until the end, because I am going to show you a simple protection method that can prevent one changed payment date from throwing your entire month into confusion. The secret is not merely knowing one date. It is knowing which date belongs to you, why that date can move, what amount should arrive after deductions, and what to do before an automatic bill reaches your account. I have spent decades watching people make the same painful mistake. They look at a bank app, see a zero balance at 6 in the morning, and immediately believe Social Security stopped their benefit. Then they call a number found in a search result, speak to someone they do not know, reveal private information, or move money from a credit card to cover bills that were scheduled too early. By noon, the federal payment may appear normally, but the damage has already started. A cash advance may carry a fee. A credit card balance may begin collecting interest. A checking account may charge for a payment that went through before the deposit posted. The person did not lose money because the Social Security Administration failed. The person lost money because several systems used different clocks, and nobody explained the difference. Pay close attention to this. Social Security, the United States Treasury, the Federal Reserve Payment System, and your bank are connected, but they are not the same institution. Social Security determines whether you are entitled to a benefit and how much the gross benefit should be. The Treasury sends federal payments. Electronic payment files move through the banking system. Your bank receives the information and posts the money to your account, according to its own processing rules. One bank may show a pending deposit. Another may not show anything until the money is fully available. A third bank may advertise early direct deposit and place the money in the account before the official date. That early access feels like part of Social Security, but it is not. It is a bank feature. It can change, it can be delayed, it can disappear after an account change, a holiday, a system update, or a different payment file. The official payment date is the date you must build your plan around. Here is what almost nobody understands. There is no single Social Security payment day for every retired American. People often repeat that checks arrive on the 3rd, or that everyone is paid on a Wednesday, but both statements can be right for one person and completely wrong for another. The date depends on the kind of benefit, when entitlement began, whether the person also receives SSI, and in many cases the birthday of the worker whose earnings record supports the benefit. That last detail is where many widows, spouses, and family beneficiaries become confused. They look at their own birthday, count to the 2nd, 3rd, or 4th Wednesday, and expect money on the wrong day. The system may be looking at the birthday attached to the insured worker's record instead. For most people who began receiving Social Security on or after May 1997, the basic cycle works this way. A birth date from the 1st through the 10th usually points to the 2nd Wednesday of the month. A birth date from the 11th through the 20th usually points to the 3rd Wednesday. A birth date from the 21st through the 31st usually points to the 4th Wednesday. But those simple words hide several important questions. Which birth date controls the payment? Are you receiving on your own work record or another person's record? Did you begin receiving benefits before May 1997? Do you receive both Social Security and SSI? Is a state paying your Medicare premium? Is there a special payment situation? Most people never realize this, and that is why a person can compare dates with a neighbor of the same age and conclude that something is wrong when both payments are actually correct. Consider a widow named Linda. She was born on the 24th, so she assumes her survivor benefit should arrive on the 4th Wednesday. Her late husband, Robert, was born on the 8th. If Linda's survivor entitlement is paid on Robert's insured record, the payment cycle may be tied to the birthday on that record, not the birthday Linda has been using in her notebook. She sees her neighbor receive money on the 4th Wednesday, notices her own deposit came earlier, and thinks the bank made a mistake. Then one month, the second Wednesday, moves because of the calendar, and she becomes certain something has changed. Nothing may have changed at all. She was using the wrong birthday to predict the date. Now consider James, who started receiving benefits in 1994. His payment pattern may remain connected to the third day of the month rather than the newer Wednesday cycle. Then consider Maria, who receives both SSI and Social Security. Her SSI is generally scheduled for the first of the month, while her Social Security is generally scheduled for the third. If the first or the third falls on a weekend or a legal public holiday, the payment is normally moved to the business day before. This can create two deposits close together, a month with no SSI deposit inside its calendar boundaries, or a Social Security payment that appears on the second instead of the third. When people do not understand this, they call an early payment a bonus, and a following quiet month a missing check. That error can be financially dangerous. This is happening quietly because the calendar changes every month while household bills often stay fixed. Rent may come out on the first. A mortgage may be due on the first. An insurance premium may leave the account on the third. A utility company may withdraw money on the fifth. A credit card may take a payment on the seventh. The Social Security schedule does not adjust itself to match your private bills. Your bank does not know that the money in your account must last for medication, food, gas, and a granddaughter's school expense. The system sends the payment according to federal rules. Everything after that becomes your responsibility. The official schedule for the remaining months of 2026 shows exactly why people need to look instead of guessing. In August, the regular Wednesday groups are paid on the 12th, 19th, and 26th. In September, they are paid on the 9th, 16th, and 23rd. In October, they are paid on the 14th, 21st, and 28th. In November, the first Wednesday group is moved to Tuesday, November 10th, because the second Wednesday, November 11th, is a federal holiday. The other November groups are paid on the 18th and 25th. In December, the Wednesday groups are paid on the 9th, 16th, and 23rd. A person who simply says, "I always get paid on Wednesday," can be caught off guard in November. A person who says, "My bank always releases it 2 days early," can be caught off guard at any time. The SSI calendar creates an even more visible trap. The August 2026 SSI payment was scheduled for July 31st because August 1st was a Saturday. The September payment is scheduled for September 1. The October payment is scheduled for October 1, and the November payment is moved forward to October 30 because November 1 falls on a Sunday. The December payment is scheduled for December 1, and the January 2027 SSI payment is moved forward to December 31 because January 1 is a federal holiday. That means a person may see 2 SSI deposits in October and 2 in December, but the second deposit in each case belongs to the next month. It is not extra money. It is not a bonus. It is not a special increase. Spending it as though it were extra can create a long, painful gap with no new SSI payment during the following calendar month. This is the first major revelation. The dangerous date is not always the day the payment arrives late. Sometimes the dangerous date is the day it arrives early. An early federal payment can make a bank balance look stronger than it truly is. A person sees 2 deposits in 1 month and relaxes. A family member asks for help. A past due bill gets paid. A larger grocery trip feels affordable. Then the next month begins, and no new SSI payment comes because that month's money already arrived. The calendar did not take money away. The household accidentally spent next month's income. I want you to slow down and picture how this feels in real life. A retired woman opens her bank app at the kitchen table. She has worked since she was 16. She paid Social Security taxes from every paycheck. She raised children, helped aging parents, and carried a mortgage through years of rising prices. Now, one date on a screen controls whether she feels safe buying groceries. She sees a lower amount than expected and wonders whether Medicare took more. She sees no deposit and wonders whether a letter was lost. She hears about government systems using computers and automated reviews, and she feels as though every transaction is being watched while nobody is available to explain what happened. A veteran who spent years serving his country may have several income sources arriving on different dates. A pension comes at one time. Social Security comes at another. A disability-related payment may follow another schedule. His mortgage does not care which system was delayed. His pharmacy does not accept an explanation about federal holidays. A middle-class couple may have a 401k, a small pension, and 2 Social Security checks, yet still feel trapped because every payment enters on a different day and every bill leaves automatically. They are not poor on paper, but one timing mistake can force them to carry a credit card balance at a high interest rate. This is why I do not tell retirees to live in fear of the government or the banks. Fear makes people act too quickly. I tell them to understand the mechanism. The enemy is not a person sitting behind a desk deciding to ruin your month. The danger is an invisible chain of rules, dates, deductions, computer files, bank posting times, and automatic withdrawals. Each part may work exactly as designed while the household still loses money. Once you see the chain, you can protect yourself. And the protection begins with identifying the date that is official for your specific benefit, not the date you hope your bank will use. The second revelation is that the payment you receive in a month usually represents the benefit for the previous month. Social Security retirement benefits are generally paid after the month they are due. When a person chooses a month to begin retirement benefits, the first payment normally arrives the following month. Someone who chooses June as the month benefits begin should not expect the first regular payment in the middle of June. The payment for June generally arrives in July, according to the assigned schedule. This sounds like a small detail, but it changes everything when a worker is planning the last paycheck, the first retirement deposit, health insurance, and the money needed to cover the gap. Imagine Thomas retires from a manufacturing plant on June 5th. His final paycheck arrives June 12th. He selected June as his Social Security start month and assumes another deposit will arrive before July rent. Instead, the Social Security payment for June is scheduled in July. Thomas has enough money in his 401k, but he did not plan a withdrawal because he believed Social Security would fill the gap. Now he sells an investment quickly, possibly at a bad time, or uses a credit card. The problem was not that he did not qualify. The problem was that he confused the month of entitlement with the month of payment. This is not automatic. A retirement application does not automatically arrange your final paycheck, your first Social Security payment, your Medicare start date, your pension date, and your household bills into one smooth line. Each system follows its own rules. You have to build the bridge. A safe retirement plan includes cash for the period between the last work income and the first benefit payment. It also includes room for the first Medicare deduction, possible tax withholding, and any difference between an estimated benefit and the final amount. The Federal Reserve's electronic payment system adds another layer that most people never see. Electronic deposits travel in batches. Banks receive files, settle payments, run fraud controls, update account records, and make money available. Much of this happens overnight or early in the business day. Computer systems compare the receiving account number, routing number, name information, previous deposit patterns, return payments, and security signals. Large institutions use automated tools and artificial intelligence to detect unusual activity. That monitoring can protect you from fraud, but it can also create a temporary review when an account is new, recently changed, restricted, frozen, closed, or mismatched. Suppose a retiree changes banks because a new account offers a bonus or a higher interest rate. She updates direct deposit but closes the old account immediately. If the change does not take effect before the next federal payment file is created, the deposit may go to the old bank. The old bank may reject it. The money may return through the system before it can be reissued. The retiree sees nothing in either account and assumes Social Security stopped her benefit. In reality, the payment is traveling backward through the banking system because the destination account no longer accepts it. That process can take time, and no amount of repeatedly refreshing the new bank app will make the rejected deposit appear. The safer approach is simple. Do not close the old account until you have confirmed that the first Social Security payment has arrived successfully in the new account and that no automatic bills are still using the old account. Keep enough money in the old account to cover expected charges during the transition unless there is a fraud or safety reason that makes immediate closure necessary. Update direct deposit through your Secure My Social Security account, through Social Security, or through a bank that can send the change using the approved enrollment process. Never trust a caller who says your payment will be suspended unless you provide a password, a verification code, a gift card, cryptocurrency, or remote access to your computer. The third revelation is that pending does not mean available, and available early does not mean guaranteed early. A bank app may show a federal deposit before you can spend it. Another bank may make the money available 1 or 2 days before the official payment date as a customer feature. People become accustomed to that early pattern and schedule automatic bills based on it. Then a holiday, bank conversion, account review, or file timing difference causes the deposit to appear on the official date instead. The payment is not late, but the household's bills are early. Think about a retired couple receiving a combined Social Security amount close to the estimated 2026 average for an older couple, about $3,280 a month. Their bank often releases the deposit early on Monday, even though the official schedule says Wednesday. They arrange a $1,650 mortgage payment for Tuesday, a $340 car payment for Tuesday, and a $220 insurance payment for the same day. For 6 months, everything works. Then the bank posts the Social Security deposit on Wednesday, exactly when the official calendar says it should. On Tuesday morning, more than $2,000 in payments try to leave an account that does not yet have the federal money. The couple may face returned payments, bank charges, lender fees, and damage to their payment history. Social Security paid correctly. The bank followed the official date. The financial loss came from treating early access as a permanent promise. If this information is being useful to you so far, leave your like. It helps this explanation reach other retirees who may be planning their bills around the wrong date. The protection is to schedule major automatic payments after the official payment date, not after the earliest date your bank has used in the past. Leave at least 1 or 2 business days when possible, especially for a mortgage, insurance premium, credit card payment, or loan. A bill due date can often be changed by calling the company, particularly if you explain that retirement income arrives on a fixed federal schedule. Not every company will agree, but many will offer a different due date. This helps both lower-income retirees and comfortable middle-class retirees because timing problems do not care how much your monthly income is. A person with $1,200 can be harmed by a $35 charge, and a person with $5,000 can be harmed by several large payments hitting one day too soon. People sometimes tell me, I should not have to change my bills. The government should pay me earlier. I understand the frustration, but protection begins with what you can control. You cannot command the Treasury to use your preferred date. You can identify the correct schedule, move private bill dates, keep a cash cushion, and stop relying on a bank's early deposit advertisement. Even a cushion of $200 or $300 can prevent a chain reaction. A stronger target is enough to cover the largest automatic payments that may hit before the official deposit. For some households, that is $500. For others, it is $2,000. The amount is personal, but the purpose is the same. Time should not be able to turn a correct payment into a financial emergency. Now, we reach the question that causes the most fear. What should you do when the official payment date has arrived and the money is still not there? The wrong response is to call the first phone number sent in a text message. The wrong response is to give a stranger your Social Security number, online banking password, debit card number, or one-time security code. The correct response begins with your bank or financial institution. Social Security itself tells beneficiaries who do not receive an electronic payment on the scheduled date to contact the bank first because the bank may be experiencing a delay in posting the payment. When you call the bank, do not simply ask, "Where is my money?" Ask clear questions. Ask whether there is a pending federal deposit. Ask whether the account has any restriction, freeze, negative balance hold, return deposit, or recent change that could prevent posting. Ask whether the routing number or account number changed after a merger or account conversion. Ask whether the bank received and rejected a deposit. Write down the time of the call and the representative's name or identification number. Do not accept a vague answer if the official date has passed, but remain calm. The first goal is to identify whether the payment reached the bank. If the bank confirms that no payment was received, then contact Social Security through the official number or your local office. The official toll-free number is 1-800-772-1213. A late, missing, or stolen payment can be reviewed, and if the payment is due, Social Security can replace it. If you still receive a paper check, the official calendar advises allowing 3 additional mailing days before contacting Social Security because mail delivery is different from electronic deposit. But paper checks are becoming far less common as federal payments move toward electronic methods. This difference matters. A person with direct deposit should not wait several weeks because someone told them all missing payments take time. A person with a mailed check should not assume a check is stolen on the exact scheduled date. The method of payment changes the correct response. Here is what almost nobody understands. The schedule tells you when to expect the payment, but the payment method tells you how to investigate a problem. The move toward electronic payments has become more important. Federal policy has been phasing out paper benefit checks, and Social Security has urged remaining paper check recipients to switch to direct deposit or an approved prepaid option such as Direct Express. Social Security has stated that paper checks are much more likely to be lost, stolen, changed, or returned as undeliverable than electronic payments. For a retiree who has received a paper check for decades, changing may feel uncomfortable. That feeling is understandable. But keeping an old method simply because it is familiar can create greater risk as the system changes around it. Electronic payment is not perfect. A wrong account number can redirect or reject money. A compromised online account can create serious danger. A bank closure can interrupt access. A prepaid card can be lost. The solution is not blind trust. The solution is controlled verification. Once a month, check the official payment date. Confirm the account receiving the deposit. Review the amount. Look for unexpected deductions. Keep the Social Security notice that explains your benefit. Keep bank contact information in a safe place. Never store passwords beside the debit card. And designate a trusted person who knows where essential records are located without giving that person unrestricted access to your money. The fourth revelation is that a payment can arrive on the correct date and still be lower than expected. Many retirees focus so heavily on the date that they miss the amount. They remember the gross benefit shown on a letter, then compare it with the net deposit in the bank and believe money disappeared. The difference may include the Medicare Part B premium, federal tax withholding, recovery of an overpayment, a court-ordered withholding, or another authorized deduction. Each possibility requires a different response. In 2026, the standard monthly Medicare Part B premium is $202.90 for most enrollees. That amount is often taken directly from the Social Security payment. A retired worker with a gross monthly benefit of $2,071 could therefore see about $1,868.10 before any other deductions, assuming the standard Part B premium and no other withholding. If the person is comparing the bank deposit with the gross benefit, the account looks short by more than $200. Nothing was necessarily stolen. Medicare was paid before the remainder reached the bank. Higher income retirees can pay more than the standard Part B premium through the income-related monthly adjustment amount, often called IRMA. The surprising part is that Medicare generally uses tax information from 2 years earlier. A person may retire in 2026 and have far less income now, but a strong 2024 tax return can still cause a higher Medicare premium. The retiree opens the bank account, sees a smaller Social Security deposit, and thinks the payment schedule changed. The date did not change. The deduction changed. This is where the IRS, Medicare, and Social Security connect. The IRS receives a tax return. Medicare uses income information to determine whether an extra premium applies. Social Security generally collects the premium from the benefit payment. A decision made 2 years earlier, such as a large 401k withdrawal, a Roth conversion, the sale of investments, or a year of unusually high work income, can reduce the Social Security deposit now. The systems are doing a conference of information behind the scenes. The retiree experiences only the final number in the bank. But there is an important protection. When income has gone down because of certain life-changing events, such as retirement, loss of work, divorce, death of a spouse, or loss of income-producing property under qualifying circumstances, a person may be able to ask Social Security to use more recent information to review the Medicare adjustment. Form SSA 44 is commonly used for this request. This is not automatic. Nobody is going to tell you about this at the exact moment you open your bank app and see less money. You have to claim it by asking for the review and providing the required proof. Most people think they do not qualify for help with Medicare costs because they own a home, have a small savings account, or receive more than the lowest SSI amount. That assumption can be wrong. Medicare savings programs can help eligible people pay Part B premiums and, depending on the program, other Medicare costs. Federal guidelines exist, but states can apply rules that make eligibility different, and some limits may be higher than people expect. This helps both lower-income retirees and comfortable middle-class retirees, especially when a recent retirement, medical expense, widowhood, or change in household income has altered the financial picture. Think about the impact of this. The standard Part B premium in 2026 is $202.90 a month, Over 12 months, that is $2,434.80. If an eligible person qualifies for a program that pays that premium, the improvement in monthly cash flow can be meaningful. Yet this is not automatic in many situations. Most people think they do not qualify. They never apply. The money keeps leaving the Social Security payment every month, and nobody at the grocery store, bank, or pharmacy tells them that an application might change the result. I am not saying everyone qualifies, and I am not promising a benefit. Income and resource rules matter. State rules matter. Household circumstances matter. This content is educational and does not replace personal financial, legal, tax, or accounting advice. What I am saying is that guessing is not a decision. If a monthly deduction is creating hardship, check the actual rules through your state Medicaid office, the Medicare program, a state health insurance assistance program, or another trusted official source. You have to claim it when an application is required. The fifth revelation is that the tax problem often appears long after the payment date. Social Security does not always take federal income tax from a monthly benefit unless the beneficiary requests voluntary withholding. A person can receive the full deposit month after month and feel relieved, only to discover at tax time that part of the benefits became taxable because of other income. Up to 85% of Social Security benefits can be included in taxable income for some taxpayers. That does not mean the government charges an 85% tax rate. It means as much as 85% of the benefit may be counted when taxable income is calculated. The calculation looks at more than Social Security alone. In simple terms, the IRS considers 1/2 of Social Security benefits plus other income, including certain tax-exempt interest. For a person filing as single, head of household, or qualifying surviving spouse, the commonly discussed base ranges begin around $25,000, with a higher range above $34,000. For a married couple filing jointly, the common ranges begin around $32,000, with a higher range above $44,000. These thresholds have caused confusion for years because a retiree can have modest income by modern standards and still discover that part of the benefit is taxable. Now tell me in the comments, did you already know that the birthday controlling a Social Security payment may be connected to the worker's record, or are you hearing that for the first time? Consider a married couple receiving $36,000 a year in combined Social Security and taking $30,000 from a traditional 401k. Half of the Social Security is $18,000. Add the $30,000 withdrawal, and the number used in the tax calculation is already $48,000 before considering other items. The couple may find that a substantial portion of Social Security is included in taxable income. If no federal tax was withheld from the benefits and too little was withheld elsewhere, April can bring an unexpected bill. This is another timing problem. The bank deposit looked correct every month. No payment was missing, but the household treated the entire amount as spendable even though part of it might later be needed for tax. The cost appears months after the original deposits, which makes the connection hard to see. A 401k withdrawal in February can influence the tax on Social Security for the year and may also affect Medicare premiums later through the income information used for IRMA. One decision can touch 3 systems at 3 different times. Form W-4V allows a beneficiary to request voluntary federal tax withholding from certain government payments, including Social Security, using fixed percentage choices such as 7, 10, 12, or 22%. The right choice depends on the full tax picture. A person with only Social Security may need no withholding. A person with a pension, work income, investment income, and traditional retirement withdrawals may need more planning. The important lesson is that the IRS does not organize this for you automatically. You have to decide whether withholding or estimated tax payments are appropriate. Do not choose a withholding percentage simply because a friend chose it. A widow with $28,000 of Social Security and no other income has a different situation from a retired executive receiving $48,000 of Social Security, a pension, dividends, and $60,000 from a traditional IRA. The same deposit date can carry very different tax consequences. This is why people who appear comfortable can still be surprised. This helps both lower-income retirees and comfortable middle-class retirees because the purpose is not to reduce every payment. The purpose is to prevent a future bill from consuming money that was already spent. Roth IRA withdrawals can be different from traditional IRA or 401k withdrawals when the rules for qualified distributions are met, but Roth planning should not be reduced to a slogan. Conversions can create taxable income in the year of conversion. That income may influence the taxation of Social Security and later Medicare premiums. A conversion can be useful, but the calendar matters. Doing a large conversion without considering Social Security and Medicare can cause a retiree to solve one tax problem while creating two cash flow problems. Banks do not calculate your future tax bill when they show an available balance. A balance of $8,000 looks like $8,000 available to spend. The app does not place a warning beside $2,000 that may be needed for tax. Credit card companies do not warn that a large IRA withdrawal used to pay debt may raise taxable income. The financial system displays transactions. It does not protect the purpose of the money. That protection must come from your own plan. The sixth revelation concerns credit and automatic payments. Your Social Security payment itself is not a loan, and receiving it does not build a credit score. But the way you schedule bills around the payment can affect credit. A mortgage payment reported late, a credit card payment missed by enough time to be reported, or a loan that becomes past due can damage a credit history. The original cause may be nothing more than using the wrong Social Security date. Imagine a retired teacher named Carol. Her birthday is on the 17th, so her payment normally falls on the third Wednesday. She changes banks and sees the deposit arrive early twice. Believing the new early date is permanent, she moves her credit card payment forward. The third month, the deposit arrives on the official Wednesday. Her checking account rejects the card payment. She does not notice the email because it goes to a spam folder. The card company adds a fee. Interest continues. If the payment remains unpaid long enough, the account can be reported late. One date that Carol misunderstood begins affecting credit that took decades to build. Credit scores are created from information reported by lenders, not from a secret judgment about whether a retiree is good or bad. Payment history. Balances compared with credit limits, length of credit history, types of credit, and recent applications can matter. Algorithms process the information. Banks also use automated systems to look for fraud, unusual transfers, and risk. A sudden large transfer after a Social Security deposit may trigger a security question. That does not mean the government has accused you of a crime. It means financial institutions monitor patterns as part of fraud control and banking regulation. Still, retirees must be careful. Scammers understand payment dates. They know when bank balances are likely to rise. They send texts claiming to be Social Security, Medicare, the IRS, a bank fraud department, or a delivery company. They create urgency. They say a benefit is suspended, an account is under investigation, or a refund must be claimed immediately. They ask the person to verify a code that actually allows access to the account. The timing is intentional. A scam sent near a federal payment date feels more believable because the person is already watching the bank. The real agencies do send notices and may contact people, but no legitimate solution requires buying gift cards, sending cryptocurrency, moving money to a so-called safe account, or giving remote computer access to a stranger. A bank employee will not need your online banking password. A Social Security representative will not need a debit card PIN. An IRS agent will not demand that you stay on the phone while withdrawing cash. When a message creates panic, stop. Use the phone number on an official statement, the back of the bank card, or the official government website you type yourself. Here is a rule that can protect years of savings. Never make a large financial move during the same phone call in which you first learned about the supposed emergency. Hang up. Verify independently. Speak with a trusted family member, accountant, attorney, bank branch employee, or official agency. Real problems remain real after you take time to verify them. Scams depend on stopping you from thinking. The seventh revelation is that Social Security notices, Medicare notices, IRS records, and bank records can disagree temporarily because they update on different schedules. A benefit notice may show a new gross amount. Medicare may send a premium decision. The bank may show the old net amount for one cycle. The IRS may later send Form SSA 1099 showing annual benefits. A retiree sees 3 different numbers and assumes fraud. Sometimes fraud exists, but often the numbers represent different periods or different stages of processing. The correct way to compare is to place the information side by side. Start with the gross monthly Social Security benefit. Subtract the Medicare premium shown for that month. Subtract voluntary federal tax withholding, if any. Subtract any clearly identified recovery or other authorized withholding. The result should be close to the net bank deposit. Then compare the payment date with the official calendar for your group. If the date or amount is different, Look for a notice explaining the change. Do not throw away a Social Security letter because the first page looks routine. Do not assume a Medicare premium notice is advertising. Do not ignore an IRS letter because you are afraid to open it. The envelope itself does not take money. Delay can. Many notices include a time limit to respond, appeal, provide information, or request a review. Read the date, the reason, the amount, and the deadline. Keep the envelope if the mailing date could matter. Make a copy of anything you send. At the same time, do not trust every piece of paper that uses an eagle, a flag, or the words official notice. Private companies design mail to resemble government correspondence. Look for the actual agency, the official address, and a clear explanation. Verify phone numbers independently. A real Medicare or Social Security issue can be handled through official channels. A private advertisement may be selling insurance, a loan, a home service, or access to information that is available free. The eighth revelation is the most important because it combines every part of the system. The greatest payment date risk is not a single missing deposit. It is a chain reaction created when an early payment, a deduction, and an automatic bill happen in the wrong order. The system functions like quiet gears behind a wall. Social Security calculates the gross benefit. Medicare removes a premium. Federal tax withholding may remove another percentage. Treasury sends the electronic payment. The Federal Reserve System moves the file. The bank posts the net amount. Automatic payments begin leaving the account. Credit systems record whether debts were paid. The IRS later examines annual income. Medicare may use tax information from 2 years earlier. Each gear turns at its own speed. Picture the chain in October 2026 for an SSI recipient. The regular October SSI payment arrives October 1. The November SSI payment arrives early on October 30th because November 1 is a Sunday. The bank app now shows 2 federal deposits during October. A relative sees the balance and asks for $400. The recipient pays an annual insurance bill of $600 and buys winter supplies. November begins. No new SSI payment arrives because November's money already came on October 30th. Rent leaves the account. A utility payment follows. The balance falls below zero. The bank rejects a payment. A late fee appears. The person uses a credit card for groceries. Interest begins. By December 1st, when the next SSI payment is scheduled, part of that money is already needed to repair the damage. Nothing in that chain looks dramatic at the moment it happens. There is no alarm. No government employee calls to say, "Do not spend the second October deposit." The banking app does not label it in large letters as November income. The card company does not say, "This purchase exists because the calendar shifted." The system is silent. That is the hidden rule. Early money creates a longer waiting period after it. The earlier the payment comes, the more carefully it must be protected for the month it belongs to. The same issue appears at the end of December 2026. December SSI is scheduled for December 1. The January 2027 SSI payment is scheduled for December 31 because January 1 is a federal holiday. 2 SSI deposits may appear in December. Holiday expenses are everywhere. Family needs feel urgent. Stores advertise discounts. A retiree may believe the second deposit gives room to spend. But January can then pass without a new SSI deposit. That December 31st, money must survive January rent, food, utilities, prescriptions, and transportation. Spending it during the holidays is borrowing from January without calling it a loan. This is why the most powerful protection tool is a monthly payment map. It can be one sheet of paper. Write the name of each benefit. Write whether it is Social Security retirement, survivor, disability, or SSI. Write the birthday or record that controls the payment. Write the official date for the current month and the next month. Write the expected gross amount. Write the Medicare deduction. Write tax withholding. Write the expected net deposit. Then, write every automatic payment scheduled from 3 business days before the deposit through 5 business days after it. When those dates are visible together, hidden risks become obvious. You may discover that the insurance payment leaves 1 day before the official deposit. You may discover that a bank has been releasing funds early and you have mistaken that habit for a federal guarantee. You may discover that November has no SSI deposit because it arrived October 30th. You may discover that the amount is lower because the 2026 Medicare Part B premium is being deducted. You may discover that a spouse's birthday, not yours, controls the Wednesday. The next step is to create 3 separate mental boxes, even if all the money remains in one account. The first box is money for fixed bills. The second is money for food, medication, gas, and daily living. The third is money that arrived early for the next month. Do not allow the third box to become available for ordinary spending merely because the bank balance is higher. Some people use a separate savings account for the early payment and move it back on the first day of the month it belongs to. Others keep a written ledger. The method matters less than the separation. Now let me show you the protection routine I promised at the beginning. 7 days before the expected payment, open the official Social Security payment calendar or your Secure My Social Security account. Confirm the date. Do not rely on a social media post, a neighbor, or last month's date. Then confirm the account where direct deposit is going. Look at the last benefit notice and identify the gross amount and deductions. Check whether Medicare sent a new premium notice. Check whether you requested tax withholding. Review automatic bills scheduled before and immediately after the deposit. 2 business days before the official date, make sure no large payment is depending on early access. If it is, move money from your cushion or contact the company about changing the withdrawal date. On the official date, check the bank once in the morning and again later if necessary. Do not panic at midnight or before the bank completes normal posting. If the deposit is still missing when the bank says posting should be complete, contact the bank and ask whether the payment is pending, rejected, held, or never received. If the bank did not receive it, contact Social Security through the official channel. When the payment arrives, compare the net amount with your written expectation. A difference of $1 can come from rounding or a small adjustment. A difference of $202.90 may point to the standard 2026 Part B premium. A larger difference may involve IRMAA withholding, an overpayment recovery, or another action that should be explained in a notice. Do not guess. Find the notice or ask for an explanation. A correct date does not prove the amount is correct, and a correct amount does not prove the account is secure. Then protect the next payment date immediately. This step is where most people fail. They solve the current month and stop looking. But the next month may include a weekend, holiday, or early SSI payment. Write the next date before spending the current deposit. This is not automatic. Nobody is going to tell you about this while you are standing in a grocery store or paying a medical bill. You have to claim control of the calendar yourself. The routine also protects families. An adult child helping an older parent can use the payment map without taking control of the parent's money. Sit together. Read the official notice. Confirm dates. Review automatic bills. Turn on bank alerts for deposits, low balances, password changes, and large withdrawals. Do not create a situation where one family member secretly controls everything. Transparency reduces fraud and conflict. If you want to continue receiving information like this, consider subscribing to the channel and activating notifications so you do not miss the next videos. People living outside the United States, people with garnishments, tax levies, state-paid Medicare premiums, or special payment arrangements may follow exceptions that do not fit the simple birthday chart. Do not force a complicated case into the basic rule. The chart is a starting point, not permission to ignore a notice. If your actual history has followed the third of the month for years, and a generic online post says you should be paid on a Wednesday, trust your official record and verify before changing bills. The same caution applies when a payment date appears to change after a spouse dies. Survivor benefits, one-time death payments, and changes from one record to another can create a transition period. A household that had 2 Social Security deposits may later receive 1 survivor benefit, and the amount is not simply the 2 old payments added together. The payment date may also follow the record connected to the survivor entitlement. Grief makes paperwork harder. This is a time to ask for written explanations and avoid quick financial decisions. Working while receiving benefits before full retirement age can also cause withholding under the retirement earnings test when earnings exceed the yearly limit. In 2026, the lower annual exempt amount for someone under full retirement age is $24,180, or $2,040 a month under the monthly figure shown by Social Security, with $1 in benefits withheld for every $2 of earnings above the limit under the annual test. In the year a person reaches full retirement age, the higher limit is $65,160, or $5,430 a month for months before reaching full retirement age, with $1 withheld for every $3 above the limit. Beginning with the month full retirement age is reached, that earnings limit no longer applies. A beneficiary who does not understand this can interpret a withheld payment as a bank delay. The deposit date arrives, but no money appears or the amount changes because Social Security is applying the earnings rule. This is not the same as losing the benefit forever. Benefit calculations can be adjusted later to account for months withheld, but the immediate cash flow effect is real. A person planning to work after claiming should report earnings accurately and understand how the test applies. Inheritance creates another point of confusion. Receiving inherited cash is not automatically the same as taxable income, and federal estate tax generally applies only to larger estates under the rules in effect. But inherited retirement accounts, investment sales, and state estate or inheritance taxes can create separate obligations. The bank shows cash. It does not explain the tax treatment. Inflation adds pressure to every mistake. The 2026 Social Security cost of living adjustment is 2.8%, and the estimated average retired worker benefit payable in January 2026 rose from about $2,015 before the adjustment to about $2,071 after it. But a cost of living increase does not guarantee that the net bank deposit rises by the same number of dollars. Medicare premiums can increase. Tax withholding can increase because it is a percentage. Other deductions can change. Prices for housing, food, insurance, utilities, and services can rise differently from the official adjustment. A retiree may read that benefits increased 2.8% and expect a noticeable improvement. Then, the bank deposit rises only a little. The person thinks Social Security kept the increase. The real answer may be that the gross benefit increased while the Part B premium rose from $185 in 2025 to $202.90 in 2026, an increase of $17.90 a month. For someone with a smaller benefit, that Medicare increase absorbs a meaningful part of the Social Security increase. The date is correct. The gross amount is correct. The net feeling is disappointment. This is why protection requires looking at gross and net separately. Gross is what Social Security says the benefit is before deductions. Net is what reaches the bank. Household bills are paid with net money. Tax planning and benefit comparisons often begin with gross money. Mixing them creates confusion. Write both numbers. Do the same with retirement accounts. A 401k statement may show $300,000, but that does not mean $300,000 is available to spend without tax. A traditional retirement account generally contains money that may be taxable when withdrawn. A Roth account may provide tax-free qualified withdrawals when rules are met. An inherited account may have required distribution rules. The bank account shows cash after a withdrawal, but the IRS sees income information later. The calendar of money and the calendar of tax are not the same. Interest rates create another silent cost. When payment timing fails, people often use credit cards as a bridge. A $1,000 balance carried at a high annual percentage rate can grow even when the person makes minimum payments. The exact cost depends on the card, but the principle is simple. Borrowing for 10 days because a deposit date was misunderstood can become borrowing for 10 months if the next payment is already committed to other bills. Protecting the payment date is therefore also a debt strategy. Banks benefit when customers use overdraft products, carry credit balances, or pay fees. But it is not necessary to assume a conspiracy. The products are disclosed, and customers agree to account terms. The problem is that the person who understands timing pays less, while the person who guesses pays more. Rules favor the informed because the informed person knows when to move a due date, decline an unnecessary service, maintain a cushion, or challenge an incorrect charge. For people receiving Direct Express, the same basic calendar still matters. The card is a way to receive federal benefits electronically without a traditional bank account. It is not an extra benefit and does not create a different Social Security entitlement. Protect the card, PIN, and online access. Review transactions. Report loss or suspicious activity through the official card service. Do not give card information to someone claiming they need it to release a payment. Now think about the payment date as a small piece of a larger retirement control system. The date tells you when money should arrive. The benefit notice tells you why the amount is what it is. The bank statement tells you what actually happened. The tax return tells you how income was treated. The Medicare notice tells you what health coverage costs were removed. The credit report shows whether timing mistakes affected debts. Each document answers a different question. The climax of this entire issue is simple, but it is powerful. Your Social Security payment date is not merely a date. It is the central timing signal for a network of private and public systems that can either protect your retirement or slowly drain it. The official date controls when you should expect the money. The bank's posting behavior controls when you see it. Deductions control how much arrives. Automatic bills control how quickly it leaves. Tax rules control how much may be owed later. Medicare rules can use old income to reduce a future deposit. Credit systems record what happens when the timing fails. The hidden danger is the gap between those systems. The gap between an early bank deposit and the official date. The gap between gross and net. The gap between a December 31st SSI payment and the next payment after January. The gap between a 401k withdrawal and the later Medicare adjustment. The gap between a rejected direct deposit and the moment Social Security receives the returned money. The gap between a missed bill and the day it appears on a credit report. Money disappears in those gaps through fees, interest, penalties, poor decisions, and fraud. But those gaps can be closed. Confirm the correct benefit record. Use the official calendar. Build bills around the official date. Protect early payments for the month they belong to. Compare gross and net. Investigate missing electronic payments with the bank first, then Social Security. Read notices. Review Medicare costs. Plan taxes before the year ends. Keep a cushion. Verify every urgent call independently. These are not complicated investment strategies. They are basic acts of financial protection. Do not be ashamed if you did not know these rules. Millions of people worked their entire lives without anyone explaining that the birthday on another person's record might control a deposit, that an early SSI payment belongs to the next month, or that a bank's early release feature is not a federal promise. The system is complicated. Understanding it is not a test of intelligence. It is a skill, and skills can be learned. Speak directly with the people who depend on you. Tell a spouse which account receives the payment. Tell a trusted adult child where the benefit notice is stored. Write the official Social Security number in a safe place. Keep the bank's real fraud number. Do not wait for an emergency to organize this information. Protection created during a calm week is stronger than a decision made during a frightening morning. There is still time to change bill dates, create a payment map, apply for help you may qualify for, request review of an incorrect Medicare adjustment, change tax withholding, correct direct deposit information, or report a missing payment. This is not automatic. You have to claim the protections that require action. Most people think they do not qualify or believe the process will be too hard. Start with one call, one form, one official account, or one sheet of paper. Your retirement should not be controlled by confusion. You earned the right to understand when your money arrives and why the amount changes. Calm knowledge is stronger than panic. A correct calendar is stronger than a rumor. A written plan is stronger than a bank habit. And a protected payment is worth more than an early payment that is spent before its month begins. Share this video with a family member or friend who receives Social Security, SSI, survivor benefits, or disability benefits. One correct date may protect them from a returned mortgage payment, a scam, or an entire month of unnecessary fear. And if you think this is important, I recommend watching the next video appearing on the screen now. In it, I explain another situation that can directly affect the money of millions of retirees and that almost nobody is watching.